Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. I've had YouTube subscribers request me to look at several stocks. One of them has been Lockheed Martin, and run my FastGraphs evaluation on this company. I think it's a very interesting stock to look at, and what I'm going to do with this particular video, I'm also going to look at General Dynamics simultaneously because you're going to see some similarities that I find quite important in terms of relative understanding valuation. And what we're really talking about here is when are good times to buy, sell, or hold the stock. So let's take price off of this graph and let's look at Lockheed Martin's operating earnings growth going back to 1999. And I want you to see that there was some poor growth coming into the recession of 2001. Then the company was producing really decent growth. You can see the growth rates down here at the bottom where the rates of change of earnings growth were extremely high in some years, 48% in 2006. But there is always some cyclicality in this. And then we came into the Great Recession, and then I want you to notice that earnings flattened during this period of time. You can see the numbers down here. We had 6%, 3%, 1%, 0% growth. So this low growth area was important, but it was also exacerbated by the Great Recession. So let's put monthly closing stock prices. Now this orange line is a PE ratio of 15, which provides an earnings yield valuation reference of about 6.5 to 7%. We see periods where valuation got very high back in 2002, and then it kind of reverted to the mean. Then it tracked the PE 15 pretty consistently for 2 or 3 years. And then a couple of things happened. We not only hit the Great Recession, but we hit a political environment where we were talking about defense spending cuts, etc. So all of a sudden we had very low multiples on this stock. Notice as I'm running across here, the PE was around 10 or 11. So I'm going to use my custom valuation ratio, and I'm going to add a PE ratio of 10. It'll be a magenta line, and you can see that now I've got multiple valuation references. The normal PE has been around 15.5 for this company historically. The theoretical fair value reference is 15, and now we have this 10. And you can see a couple of things here I think are important. One is this 10 PE ratio was relevant during this really low growth environment for the company. Growth rates were extremely low during this period of time, but then they've now recovered. But what I want you to see is the price eventually reverted to the mean PE of 15 and kind of stayed there, got a little overvalued in 2014 and came back down. And then, under the new administration, more aggressive defense spending, etc., we all of a sudden seen some irrational exuberance, perhaps you might call it, in defense stocks where the PEs got real high up here into the 20 range. And this is General Dynamics I'm looking at here. But I do want you to notice this correction, which looks like an apparent potential reversion to the mean. So there still could be some further downside. General Dynamics is still moderately overpriced. Now, when I go to Lockheed Martin and keep everything the same here on this graph, you're going to see almost the same identical graph as we saw with General Dynamics. You see high valuations, you see, this roughly 10 PE ratio existing for 3 or 4 years coming out of the Great Recession. And then we see this acceleration in growth, acceleration in optimism, and the price got real high. But the bottom line is, I would still consider both of these stocks overvalued at this point. There'll always be short-term volatility, but my fair value would be about 240 to about 273, and the stock currently trades at 317. So if I just run a short calculation, I'll shorten the time frame here so you can see the numbers a little better. If I just run a calculation of what my returns could be out to, let's say 2020, assuming these analyst estimates with some pretty good growth rates are correct, the stock only offers me about a 4.5% total annualized rate of return simply because of overvaluation, not really relevant to the company's growth potential or the operating results of the business. Now, if I go back to General Dynamics, I want you to see that you've got a similar company in a similar industry, and you've also got similar potential here. You get a little higher rate of return in General Dynamics because, growth going out there might be a little higher and the valuation might be a little better today. But the point is, as I look at both of these stocks from a long-term perspective, one thing that I want the viewer to notice is that you had normal PE ratios of 15-ish for all these years, and you see very clear times when the price got above that and the price came down. We're looking again at General Dynamics here. When we look at Lockheed Martin, we once again see almost identical situation. And what I'm trying to suggest here is a lot of times you'll see companies in similar industries look very, very similar in terms of their operating results, but also in terms of how the market values them. So what we have now, we had pessimism in the defense stocks. I'm back to Lockheed Martin again, but this would have been a great time to buy the stock even here. Had you bought it when the PEs got down below 10 for the first time, you'd have had dead money, as some people would call, for 3 or 4 years, other than the dividend income. And let's look at dividend yield during that time, because it's important. Your dividend yields during this period would have been significantly higher. So you were kind of being compensated for the low valuation with a high current dividend yield. But then if you'd have held the stock through today, your rate of return would have averaged over 20%. But there's a lot of things that are creating the calculation here. One is you've got a resurgence of earnings growth. Clearly, you're starting to see earnings growth numbers that are double digit, again, with occasional cyclical results in between. But you're also seeing PE expansion. Your PE went from 9.7 all the way up to the current PE of 21. So that's more than, a doubling of the PE ratio. And that PE ratio expansion has a lot to do with what created that rate of return. I go back to General Dynamics, again, a very similar stock in a very similar industry with very similar attributes. And if I run that calculation again, here I got down to a 9.3 PE, I'm up to a 15% rate of return. But again, I had dead money for a while until the market began to get excited about defense stocks again. So the point is this: when you're making buy, sell, and hold decisions, and when you're even calculating performance, it's, I always say calculating performance without simultaneously calculating valuation is a job half done. We had very low values here. This would have been a great time to be building positions in either one of these stocks, Lockheed Martin or General Dynamics. You were getting above average yields on these stocks during these times when their value was low. They both have good records of raising their dividend. The current yield is low at 1.9% for General Dynamics. And if I go back to Lockheed Martin, it's 2.5% for Lockheed Martin. And that simply is telling me that because of the high valuation, it's a moderate yield, not really a great yield. But I also want to point something else out. If you go back, the current PE is around 21. So if I go back and find a similar PE ratio for this stock, which was December of 2002. I didn't hit it, I can't get it perfectly. But the point is, it generated a 6% long-term rate of return because the PE was high. In contrast, had I waited and been a little more patient and bought the stock at a more attractive PE, like for example, I already showed you if I buy it in this 10 range, then you're looking at rates of return that turn out to be double digits, 17, 18%. But again, valuation has a lot to do with that. So both of these are excellent companies in my opinion. They both have a lot of debt, or at least Lockheed Martin has almost 98% debt. Let's go back to General Dynamics here and see they have only 25% debt and they're A+ rated, where Lockheed Martin in contrast has 98% debt and they're only BBB+ rated. So, when you're valuing these stocks, you want to take all these things into consideration. And there are always differences when you're looking at stocks, but there are often similarities when you're looking at companies in the same industry. For example, if you looked at Lowe's and Home Depot, you would see very similar operating history graphs and similar price action because they're both working in the same industry. You have the same situation going here with Lockheed Martin. So I consider it still an overvalued stock. If I'm looking at forecasting growth going forward, the market does expect growth to be exceptional, double-digit 15% growth over the next several years. It's well followed. There are 17 analysts forecasting that growth. The long-term trend line growth is expected to be a little lower, though, and that would imply there's expectations of some cyclicality in the way. Even if I apply normal multiples, these stocks don't offer a great rate of return for the next couple of years, but assuming they do hit these growth targets, the returns start getting better over the long run. But my point is, I might look for a more opportune time to buy this stock. I'm not saying you would lose money buying it here. You might have short-term losses, but I don't think this is the opportune time to buy the stock. And like Warren Buffett once said, be greedy when others are fearful and fearful when others are greedy. Nobody wanted Lockheed Martin when it was trading down here at 10 multiples, and now all of a sudden everybody wants it when it's trading at double that multiple or trading at 20 multiple. Anyway, here's a quick look at Lockheed Martin and General Dynamics. If you found what you saw here interesting, you might want to take a closer look at fast graphs. You can call us. Our number's 813-960-9600, or you can email us at www.fastgraphs.com. It's a great tool to help you make good, solid buy, sell, and hold decisions. This has been Chuck Carnevale saying thanks for watching.